You're watching BloombergQuint to talk to us about, the pressures that the global economy is facing, but equally what that means for his own company. That's Bharat Forge. We have with us this morning Amit Kalyani. Thank you very much, Amit, for speaking with us. The last few months have been tough for a variety of your key businesses. You would say, A, the trade war, B, the slowdown in the US truck market. All of those numbers weighing in on your stock price as well?
I think the stock price is something that I have really little to do with, but while the orders on the Class 8 trucks are lower than they were, the backlog is so large that next year should still be a pretty good year. And besides the Class 8 trucks, we also have a new growth coming from passenger car sectors, from our industrial sector, and many other sectors that we've been incubating over the last few years. So, notwithstanding something really catastrophic, I think we should still have a fairly good year next year.
Fair enough. So, will you talk us through then what your broad outlook is for some of the key contributing sectors, both the ones that you've had for a long time, the newer diversified sectors that you've introduced in the last few years?
Actually, we have a board meeting coming up very soon, so I can't give earnings.
Yeah, so I'm not asking you for a short or medium-term outlook, but just a broader, more general outlook. I'm not getting into specifics.
Sure. So I'll tell you, what we've done is we focused on creating new capabilities in order to supply components and solutions that we haven't been doing or haven't been doing at the scale at which the potential is today. For example, we've set up the lightweighting center in India. We've expanded our aluminum forging business in Europe. We will do the same in the US. This will add a significant quantum increase to those businesses and provide a new platform for growth going forward. We see the whole lightweighting business, which potentially today is about, let's say, in the region of 100 million, could easily become somewhere in the region of 400-500 million in the next 5-6 years. Similarly, if you look at the passenger car sector, we predominantly be present only in engine components. We've now developed a lot of chassis component products, new engine component, value-added products, and also we're now creating products for the electric vehicle sector. So EVs have a lot of structural components, a lot of mechanical components, electrical components, which we never used to do. So we have now developed the technology to create some products for these sectors. So these are things that will come online in the next 2 to 3 years. Similarly, we are targeting the electrification of industrial products as well and the control systems for that. So we've been doing some initial work on that over the last 2 years in our center in Myra as well as in Pune. And those are all areas that will come on stream, in the next 2 to 3 years. So we're broadening our base, we're adding a lot of new capabilities, and I think that's how we will grow our business, by growing content per vehicle and by getting into new sectors that we've not been present in.
Okay, fair enough. What is the mood like back home in India, in the sense, and by that I mean that, do you feel that there is enough demand in the economy to suggest that the underlying strength is sustainable?
There's really nothing wrong with the Indian economy.
No,
I think there's just a hangover of this bad mood, coming from all the global cues, and uncertainty about what's happening globally. Some major events coming up in the next few months in India. So I think people have gone from, let's do things now to let's wait and watch. So that's the kind of thing that we're seeing. And also there are some, issues around, the whole IBC process and other things which should have been more expeditiously, expected to happen more expeditiously. Only a few of them have panned out. So a lot of different little bits and pieces which came out as outliers have now caused a little bit of a, let's say, mood effect in India.
But you're saying so demand is sustainable. What's the outlook on the order book, let's say, for the next 2 years?
See, we work in a derived demand business. So we talk about our demand based on what our customers tell us. And the Indian automotive sector is supposed to grow at double digits domestically. And our global business, because of the reasons I told you earlier, should also grow at double digits. So overall, I think we are in a strong position. I think the Indian sector, the industrial side, the investments will start again. I mean, the power sector, all these areas will start seeing investments again.
Are you seeing green shoots there?
Not yet, but because the capacity utilization has gone up.
Okay.
And a lot of old plants will have to shut down, new plants will have to come up. So across sectors, whether you look at steel, whether you look at cement, whether you look at power, I think we're on the cusp of a pretty large CAPEX cycle starting in the next maybe 18 to 24 months. So that gives...
You're hopeful. You haven't seen signs yet.
I've looked at the capacity utilizations.
Okay, and that's what's giving you the sense.
Then that's what's giving us the sense.
Okay, then let me ask you one final question. Again, it's not from this quarter's point of view, because I know that you've yet to announce earnings, but we've seen a softening in your profit margins over the last 2-3 years. Might have been an outcome of diversification, different products, etc., etc. But can you give us some sense of when you, like right now, I think your margins have dropped to about 2015 levels, if I'm correct, at around 25%?
No, actually no. Our EBITDA margins are upwards of 28.5% right now. They haven't softened. What has happened is we have a raw material pass-through, so which inflates your top line and your raw material costs. Our EBITDA per component or per product is at the levels we had, if not more or less in the same, slightly maybe higher even, if you were to discount for the inflationary impact of the price increases.
And that outlook, therefore, on margins remains stable?
Remains stable. What we've said is between 28 and 29%.
And you're going to be able to keep it there for the next 2 years?
Well, that's
Or do
the
you
goal.
see that if this investment or CAPEX cycle kicks in, as you hope it will and you expect it will, that you might in fact see an improvement in margins over the next 2 or 3 years? Or do cost pressures keep that in check?
I think this is a pretty strong level of margin to operate at. When you have new business coming up, you have startup costs, you have all kinds of things. So I think I would like to keep it in this ballpark. There may be times when it's slightly higher, there are times when it's slightly lower, but if you look at the whole year, it will remain at that level.
All right. So you're sounding a fairly confident note for not just the calendar year 2019, but FY20 as well.
Yes.
Amit, thank you so much for speaking
with us. Thank you so much.
And have a good Davos.
Thank you, you too.